For 3 years, millions of American homeowners have been trapped. Not trapped in a bad investment, trapped in a great one, a sub 3% mortgage that made selling financially suicidal. Move to a bigger house? You'd pay $1,000 more per month for the same square footage. Downsize? Still more expensive. Most people chose to just stay put. And that decision locked up the entire housing market. That era just officially ended. For the first time, the share of homeowners sitting on mortgage rates above 6% has now crossed above the share sitting on golden rates below 3%. The handcuffs are breaking, not because rates came down, but because life doesn't wait for the Fed. And when millions of homeowners finally start selling, what happens to prices? That's the question. Let's get into it. To understand why this crossover matters so much, you have to go back to 2020 and 2021. The Fed cut rates to near zero. Mortgage rates crashed below 3%. Millions of Americans locked in those rates, some as low as 2.6, 2.7% on 30-year fixed loans. It was financially a once-in-a-generation opportunity, but it created a trap. Because once you have a 2.8% mortgage, selling your home means giving it up. And buying anything else right now with 30-year rates averaging 6.37% means your monthly payment on the same house effectively jumps by $1,000. On a $417,000 median home, that's roughly $600 to $700 more per month in interest alone. So people stayed. And stayed. They didn't sell when they wanted to upsize. They didn't sell when the kids moved out. They added rooms instead of trading up. The result? A housing market frozen solid by people who couldn't afford to leave their own homes. Here's why May 2026 is a genuinely historic moment for the housing market. Danielle Hale at Realtor.com confirmed what the data now shows clearly. The share of homeowners with rates above 6% has officially surpassed the share with rates below 3%. For 3 years, that low-rate group dominated. They held the majority of outstanding mortgages in America, and they were not selling. That has now flipped. This matters for 2 reasons. First, it means the supply dam is starting to break. As more homeowners sit above 6%, the psychological pain of selling and reborrowing at roughly the same rate disappears. They no longer feel trapped because they're not. They can sell, buy elsewhere, and face essentially the same rate environment they're already in. Second, and this is the part most people miss, it means the inventory problem that has driven home prices up for 3 straight years may finally begin to reverse. More sellers entering the market means more competition. More competition means less pricing power. And in markets like Florida, which is already down 2.4% year over year, and Washington, D.C., which is down 3.1%, this process has already started. This crossover reflects a gradual resetting as households trade in low-rate mortgages, even as rate lock-in continues to limit inventory. Danielle Hale, Chief Economist, Realtor.com. Here's what's important. Not everyone leaving their low-rate mortgage is doing so by choice. Life doesn't pause for the Fed. Divorces happen. Job relocations happen. Families outgrow their homes. A parent passes away. A second child arrives. These life events are forcing people to transact in a market that punishes them for doing so. And in 2026, more of those people are reaching a breaking point. Think about the math they're facing. Monthly principal and interest payments on a median-priced home now consume 39.7% of average household income. The historical healthy benchmark is 28%. That 12-point gap is real financial stress. In Florida, that pressure comes with an extra layer. Average home insurance has now hit $9,449 per year, nearly $800 a month on top of the mortgage. 47% of Florida homeowners say they'll struggle to make their full housing payment if premiums rise any further. That's not a fringe statistic. That's almost half of homeowners in one of the largest states in the country standing at the edge. Now here's the part of this story that makes the housing picture harder, not easier. Kevin Warsh was confirmed as Fed chair this week, and if you listen to what his monetary barbell doctrine actually means, the message for mortgage rates is not good. Do I think he'll cut rates? No chance. Paul Tudor Jones, hedge fund manager, Tudor Investment Corp. Warsh intends to shrink the Federal Reserve's $6.6 trillion balance sheet aggressively. The era of the Fed put, where the central bank stepped in to rescue asset prices whenever markets dropped, is being deliberately dismantled. In practical terms, for anyone waiting to see mortgage rates drop back to 5% before they make a move, that moment is not coming in 2026, possibly not in 2027 either. The market for housing is adjusting to a permanent, higher-for-longer reality, and that adjustment is going to push more people off the sidelines, because waiting for rates to fall is no longer a credible strategy. In response to affordability pressure, lenders are now offering something that didn't exist in the mainstream American market until recently: 40-year fixed mortgages. DoFi and Great Southern Bank have both launched 40-year products. The pitch is simple: stretch the loan out another 10 years and the monthly payment drops. On paper, it looks like relief. The reality is worth examining closely. On a $600,000 mortgage, extending from 30 to 40 years, adds more than $320,000 in total interest paid over the life of the loan. You're paying significantly more money for a lower monthly payment, and in a market where prices may soften, you could find yourself underwater faster than you expect. This is a product designed for affordability pressure, not financial optimization. If you're considering it, run the full cost of loan math, not just the monthly payment comparison. Here's the better move. If you're a buyer in 2026, the markets to watch are the ones already correcting: Florida, D.C., and secondary markets where the insurance burden and the forced sellers are concentrating. Those are the places where real price softening is already visible in the data. The patient buyer, armed with a pre-approval and a clear number, wins in that environment. The golden handcuff era isn't ending because rates came down. It's ending because life kept moving while everyone waited for the Fed, and as it unwinds, as more sellers enter a market that has been supply-starved for 3 years, the pricing dynamics in housing are going to shift in ways we haven't seen this cycle. The question isn't whether it happens. The data says it already is. If you're a homeowner thinking about selling, a buyer trying to time the market, or just someone trying to understand where housing prices go from here, subscribe. I break down these shifts every week, with real numbers so you can make decisions based on data instead of headlines. And if you want the full picture on Kevin Warsh and what higher for longer actually means for every asset class in 2026, not just mortgages, but stocks, crypto, and your savings account, that video is right here.